will post, as I mentioned earlier in one of our other videos, I will post these items that I'm labeling as ICPs for you, and they are just for practice. I will post one typically for every single chapter. And what you guys should do is print those out and go through them and do them as practice. And then open up the corresponding solutions video that I'm going to make and post and review them. The point of these things is like we would use them in class to go through them prior to you guys going home and working on Chapter 6 homework. And then, of course, they are extra good practice prior to the test. Okay, so the point is to do some additional problems in addition to the homework in hopes of you not making silly mistakes on the test. Alright, so let's start out here with Chapter 6, where we introduced our budgeting concepts prior to diving into the future chapters where we will focus on some variance analysis techniques. Alright, so number 1 says budgeting is the common accounting tool companies use for planning and controlling. Okay, we left out a word here in this top part. What is management's responsibility? They are to plan, direct, and control. All right, so number 1, A is incorrect. It doesn't provide just a measure of planned financial results. Okay, B is not correct because it says are prepared independent of the company's long-term strategies. No, that's definitely not correct because the word independent is in here. Budgets tie in with our long-term strategies. C is not correct. It says that budgets do not usually reflect actual results, so because of this, they are useless exercise. Oh no, they're not a useless exercise. Okay, so C is not one of our choices that's correct. So that leaves us with D. Serve as the financial expression of management's plans for the upcoming period. So that is our answer for number 1. On number 2, you guys have hopefully learned by now that when you are working on accounting problems, that many times the first thing you need to go do is read the question. So if we go down and just look, they are wanting us to calculate their projected operating income for October 2004. Well, that means we're going to have the revenues, we're going to have cost of goods sold, and we're going to have other operating expenses in order to calculate operating income. So let's go back up and pick out the information that we are going to need. So sales are budgeted at $750,000. So we're going to start our calculation with that. All sales are credit sales, and a provision for doubtful accounts is made monthly at the rate of 2% of sales. Okay, so 2% of $750,000 needs to be recognized as bad debt expense because we're not going to be collecting that most likely. So 750,000 times 0.02 will be the amount for bad debts expense. Merchandise inventory, which is an asset account, has a balance of $120,000 at September 30th, 2004, and an increase of $10,000 is planned for the month. We can consider that little tidbit of information TMI, or too much information. We do not need that. That is an asset account. We're not going to worry about that. All merchandise is marked up to sell at invoice, cost, plus 50%. Okay, so we are taking the cost of our merchandise and we are multiplying it times a factor of 1.5 and then selling it. So, with that said, $750,000 is our sales dollars. So can we not take 750,000 and divide that by 1.5 in order to get cost of goods sold? Yes, we can. So 750,000 divided by 1.5 would give us $500,000 for cost of goods sold. All right, let's go a little bit further here. Our estimated cash disbursements for selling and administrative expenses for the month are estimated to be $105,000, straight up $105,000 for selling and admin. And then depreciation expense, which definitely needs to be included on our income statement, is projected to be $25,000. So if we plug all of those numbers in, we can say sales minus cost of goods sold minus bad debts expense minus selling and admin minus depreciation leaves us with operating income of $105,000, which is A. For number 3, which of the following is not a major benefit of budgets? All right, so I really want my students to learn test-taking skills. Those of you who plan on taking a certification exam have got to get your mojo together well in advance. For the most part, on many of those tests, you guys are going to have multiple choice questions where you literally have around 1 minute and 40 seconds, give or take, depending on which one of the exams you're taking, that you have got to be able to answer these questions quickly. So find the key words and find a way to strike through answers that are incorrect. So you'll notice here that on this particular one, it uses the word not a major benefit of budgets. The key word is not. Don't get yourself all worked up over answering double negative type questions. Find the major benefits of budgets and put check marks by those or strike through those. Okay, so major benefits of budgeting definitely compels planning. Okay, so A gets a check mark. Definitely not our answer, but it is a major benefit of budgeting. C, provides performance criteria. Absolutely. This is what we are expecting our people to do during the upcoming period. Check mark. It is a major benefit of budgets. D, promotes coordination and communication. Absolutely. We are going to be communicating all of this information in these schedules and budgets with these managers and their line workers who need this information. And there is undoubtedly coordination required. We've got a lot of discussions and a lot of calculations that multiple people have to give input on in order to put these things together. Okay, so D is a major benefit of budgets, therefore it gets a check mark. So eliminates innovation is one of our items, okay? Budgets take a lot of time. Could it possibly bog down some innovation within a company? Yes, it possibly could. All right, next one is number 4, which we've got data for question 4 and 5. Hester Company budgets on an annual basis for its fiscal year. We have got beginning and ending inventory levels in number of units that are planned for the fiscal year. Notice that we have a beginning raw materials as of July 1, 2004, and an ending raw materials as of June 30th, 2005. So these people have a fiscal year that runs from July through June. These are their planned raw materials, number of units left in inventory. Finished goods inventory, 30,000 beginning 7/1/2004 and ending 6/30/2005. These are their desired or target finished goods number of units in inventory. Now they also have an additional little caveat here. 3 units of raw material are needed to produce each unit of finished product. Everybody needs to imagine a tricycle, if you will. 3 little tires are needed for each tricycle that would be manufactured. All right, so let's look at question number 4 here. If Hester Company plans to sell 500,000 units during the fiscal year, how many units would have to be manufactured during the year? All right, we can do this in a formula, but I also want to show you guys doing it in T accounts. All right, so our sales units is 500,000. We are about to calculate the production budget quantity of units. We are going to add the desired target ending inventory. Okay, we want to have 5,000 finished goods units at the end of the year, and we plan to sell 500,000. So we have got to make sure that we have enough to do that. However, we don't need to forget that we would have started with some at the beginning of the year. So that's why we're going to subtract out the 30,000 finished goods units that we started the year with. Okay, so that gives us a result of 475,000. As I mentioned, I really want my students to be very prepared for taking exams, and you will have so many formulas to study that it will not even be remotely close to funny by the time you are ready to go sit for some of these exams. So you have got to find faster ways of working through problems so that you will be successful. So use your T account skills. Basically what we're doing up here in this one is we're trying to calculate the number of units that we need to produce. Okay, so this is our finished goods inventory in units in a T account. Here's the beginning inventory for the year. Here's the desired or target ending inventory for the year. And here's the number of units we plan to sell. So you guys know how this works. Beginning inventory plus production gives us the total quantity available for sale. And we can subtract sales from it in order to get ending inventory. So can we not plug in these numbers and work our way backwards? Absolutely. So desired target ending plus sales is the amount we got to make sure we have covered. If we subtract beginning inventory from that, then we can answer how many do we need to produce. Okay, so that's what it looks like in T account formula. Here's what it looks like if you wanted to do it mathematically, or you can lay it out vertically like that formula sheet that I showed you in one of the earlier lecture videos. Okay. Next one is our direct materials that are linked to that. Here they're switching up our scenario just a touch. They are wanting to say we have got to produce on that production budget 450,000 units in order to meet our desired ending and meet sales. All right, so we're talking now about pulling information off the production budget, 450,000 units to be produced, but we're trying to calculate the raw materials that need to be purchased in order to facilitate that production. All right, so we need to say 3 units, 3 tricycle tires, if you will, for each one of those 450,000 tricycles. So 3 times 450,000 means we are going to require 1,350,000 total tires. And we want to have some tires left over at the end of the fiscal year so that when we come back in on the first day of the next year, we have some tires to work with to start making more tricycles. All right, so their management has stated we have a desired target ending raw materials inventory of 10,000. Those two numbers get added together. But we also always need to remember that we would have had some raw materials that we would have started the year with. And this particular year was 40,000 of those. So subtracting the 40,000 means we need to purchase a total of 1,320,000 of those direct materials or raw material units. Again, looking at it in a T account format here, here is the beginning inventory of 40,000 units. Here is the total number of units required for production. That's where we multiplied the 3 times 450,000 and got that result. And here's management's desired target ending of 10,000 units left. So again, this plus this equals the amount we've got to make sure we can cover. We would have started with this many, so take these two, subtract this one, and fill in the blank. Learn to use those T accounts. I promise it will be helpful. Oops, excuse me. All right, let's go look at number 6 now. Number 6, which of the following does not pertain to financial planning models in software form? As we discussed, Excel and some other specialized softwares and enterprise resource planning materials can aid us in our budgeting process. Again, we've got one here with the word not. Reduces computational burden and time required to prepare budgets. Oh, absolutely. This is why we want to use Excel or use these softwares, because you definitely do not want to be doing this stuff by hand. Okay, so this is not one of our correct answers because it does in fact apply to utilizing these types of systems in order to help us with budgeting. We really, really like the use of them. C says assist managers with sensitivity analysis. I mentioned to you guys a couple of examples in the text about changing the revenues per unit, increasing or decreasing our costs due to supply and demand issues, maybe changing suppliers due to quality issues. Things like this happen. And we would really like to be able to quickly plug those numbers into these planning models in Excel or one of these softwares and aid us in analyzing the results for if those scenarios actually were to take place. D performs calculations that are mathematical representations of relationships in master budget. Absolutely. We can program these cells with formulas. We can make the information flow all the way through all of the steps that we have seen illustrated in this chapter easily if we are using one of these financial planning models. So therefore, B is our answer. Eliminates need to update budgets as uncertainties are resolved. No, we definitely need to continue to go in and update our information as things change. Number 7, the major cost management concept used in Kaizen budgeting, which was mentioned earlier and also in the Toyota as well as your textbook, is C, continuous improvement. Number 8, which of the following statements does not describe responsibility accounting? The answer is D, because responsibility accounting does measure the plans and actions of each responsibility center. It does budget to emphasize that for which each responsibility center is accountable, and it does calculate variances between budgeted and actual accountability for each responsibility center. And again, we're going to focus on our variances after we finish Chapter 6. Number 9, controllability is D, the degree of influence a specific manager has over costs, revenues, and other items. Keep in mind, though, with the controllability, management needs to understand and also occasionally be prepared to discuss this with management, that sometimes when you guys are evaluating a manager and what deems as controllable on their report, you may need to consider individuals in their position prior to them that had an effect on the report at hand. Budgetary slack, we discussed. It's basically gaming of the system. It is giving numbers during the budgeting process that make someone's job easier. If it is revenues related, they typically turn in a number that is understated or underestimated. And then with our cost and expense type of items, those are turned in at a higher dollar amount or overestimated or over projected. And this slack provides those managers that have turned this information in with a hedge against unexpected circumstances. Questions 11 and 12 deal with our calculations that were required for our cash budget. We're trying to calculate the cash receipts for question 11 and cash payments for question 12. This is one of the ones that I mentioned to you that is a little more of an involved example for you. Again, be prepared for stuff like this when you take those certification exams and also possibly on our tests. All right, so here we've got cash sales and credit sales. Okay, so in our other example earlier, we saw just credit sales. This particular company has customers who pay upon receipt of the orders with cash. And we have others that are allowed to charge it on account, which of course is our accounts receivable. So we've got February, March, and April laid out. Let's go read the question. We want cash receipts in April. Based on our information, here is the parts that have to do with cash receipts. We have so much sold in cash sales and the remainder are on account. Management estimates that 5% of the credit sales are not collectible. So that means 5% times credit sales is uncollectible, and the remaining 95% of credit sales are collectible. Of the credit sales that are collectible, 60% are collected in the month of sale, and the remainder in the month following the sale. So we've got 0.6 at month of sale and the remaining 0.4 at the month after sale. So remember I mentioned earlier getting yourself some ways to write things out. All right, so let's go down and just scroll on where you guys can look at just this information. All right, so 95% of the sales done on account are collectible. And then of that 95%, 60% is month of sale, 40% month after sale. So if we were to go back up to our chart, we could pull from there cash sales in April, $120,000. It's given to us. April credit sales was $280,000, of which 5% is uncollectible and the remaining 95% is collectible. So 280,000 times 0.95 gives us the collectible amount of those sales, but only 60% of that is collected in the month of sale. So 159,600. For March, it had sales of 400,000 on account, of which 5% was uncollectible. Therefore, 95% would have been collectible. So much of it would have been collected in March, but we're looking for just April, and that's the remaining 40%. So 0.4 times the result of this would give us 152,000. Total those up. 431,600 is our total, which is C. All right. And then number 12, they are wanting us to calculate cash payments for March. All right, just for our inventory purchases. This one's a little convoluted too. They are telling us that our cost of purchases of inventory each month is 70% of the next month's projected total sales. Right? They're asking us on number 12 to do March's information. All right, so April's sales are projected to be a total of 400,000, and 70% of sales is equal to the cost of purchases. Okay, so 400,000 times 0.7. All purchases of the inventory are on account. So everything is going to get put on accounts payable. 25% of that is paid in the month of purchase, and the remainder is paid in the month following the purchase. Okay, so don't you guys think we're going to need some additional information left over from March's purchases, etc., in order to calculate that? So let's go down and pull up our data down here at the bottom with it all spelled out. So next month's sales times 0.7 equals the total dollar for purchases. Purchases times 0.25 is paid in the month of purchase. Remember I said practice yourself some notation. And the remaining 75% is the month after purchase. So we're looking for cash payments in March. In March, we have purchases based on April's sales of 400,000. 400,000 times 0.7 tells us $280,000 worth of purchases would have been made in March. In the month of purchase, 25% is going to be paid. So 25% of 280 is 70,000. But we know that we've also got some purchases that would have been made earlier that are going to be paid in the month after purchase. Okay, so that relates to the February purchases that are going to be paid in the month of March. So what purchases were made in February? They would have been based on the next month's sales, which was March, $550,000 worth of sales, times 0.7 means in February we would have purchased $385,000. $385,000, 75% of which would have been paid in the month after purchase. So $385,000, 75% would have been paid in March, where 25% of it would have been paid in February. All right, so if we do the math, 385 times 0.75 means 288,750. And my answer has gone down to the next page, which is 358,750 is our answer for D.